Would you like some ice for that, Claire?
I'm all right, thank you.
Okay. We'll just let that roll, at least until the card fills up, and I'm going to take copious notes. And so the first thing, and I'll interject some questions, and then when you guys hear stuff that you want to add on, just go ahead and do it. Because literally, we'll take it all, and then it's our job
You're just assembling
to parse it
content.
down. It's literally how much stuff can we get to then start to parse down. So you've got this piece of intellectual property in your head, and you guys have all worked off of it before in agreement with it. This is a piece of content, though, that we need to package up, right? So if we start to look at this as a theory or as a methodology or as an approach or whatever, what would we say this is that you're about to take us through?
I've described it as a conceptual model of our market, of the brownfields market. And it's something that I came up with in an effort to try to understand why some deals work and some deals don't. So I draw the market in a classic bell-shaped curve, not because we have the information or the data that suggests that this is the exact curve, but as a conceptual model, it's in keeping with our experience. And then you can take this universe of opportunities where if you rank them by their potential internal rate of return, there's some that have a great potential to return a high return on capital, and there's some that are desperately underwater.
Is it underwater? So not even low, actually negative.
It's a negative IRR. It'll cost you money over time just to own it. And then in the middle, roughly it's zero, and you can argue this skew ad infinitum, but it's just a conceptual model to help understand. It's not. That is not as critical as the further concepts, which is to divide it into 4 zones. And the zones then, and the reason that's important is that each of these zones will have different management and investment objectives, whether you're an owner or whether you're a buyer.
Each
And
have
frankly,
management, what else, other objective?
well, it's management and financial.
And financial.
But it's even applicable if you're a regulator. And I've given this little presentation to regulators before who have said, oh, nobody ever explained it that way before. Zone 1, I have termed investment grade. And the boundaries of Zone 1 to Zone 2, well, Zone 2 is owner finance, and I'll explain these terms in more detail. This is public partnership, and these are legacy.
It's long-term stewardship.
Long term.
How are you defining stewardship when you say that, Mike?
They're effectively untransactable, right? Stewardship means just long-term and perpetual care.
Nobody's going to buy it.
They have no valuable upside, and they have no
IRR,
cost.
the IRR concept it's implicit from the beginning that it's a transactional based evaluation. And so if we go from Zone 1 to Zone 3, in Zone 1, the outer limit of it on the positive side are sites that nobody's even identified as brownfields. And the reason for that is there's such a high yield on the investment side that any environmental issues that pop up are just absorbed within the budget, and they're a small percentage of the risk, and they just cruise right on by them.
What's an example of that?
An example of that would be probably just about any chunk of ground in Manhattan. It's so valuable that people will figure it out. People who aren't brownfields oriented, and they're investment oriented.
Union Station might be a good example, right? Old railroad waste.
Well, actually-
waste.
Union Station had a significant amount of public
Yeah.
capital
yeah.
added to the
But I mean, it
stack.
would have got done either way, because of that, the location.
Probably.
Yeah.
But it's almost inherent value of what you could do with it
Typi-
far outweighs
Typically,
anything you're gonna go. for.
typically,
So
and
it's worth it.
I
No matter what,
toyed,
it's worth it.
I toyed for a while of actually trying to come up with a kind of a mathematical ratio of problems to value to kind of do this, but it gets complicated and it gets highly arguable after that. But but from a conceptual standpoint, we put this boundary right now at about 15%, which is an opportunity has to yield an IRR of at least 15% in order to be considered investment grade, because investors who have options for their capital to go elsewhere have to get at least that for the perceived risk in order to take on one of these kind of sites. And that's a site that transacts without any other assistance, just buyer and seller purchase and sell the site.
And again, you said it's 50% what?
Return on capital, IRR. So really from a if you are an owner of a piece of property and it's desirable enough in its location and its potential use that it can be a grade 1 or zone 1 kind of opportunity, it's really done in a much more traditional real estate fashion. The environmental issues typically aren't at the top of everybody's agenda on that. The normal real estate risks associated with entitlements and so forth are dominant in this sector. And then this, but this is a floating number in the sense that it's a market set number. It's as a source of competition for capital in the marketplace against every other investment possibility. So as the cost of capital goes up, this zone shrinks because it drives this boundary in that direction without any change in the number of available opportunities. But the other aspect of this zone that's a challenge is that because it is highly desirable, the numbers, at any one point in time, the numbers in this zone are shrinking typically as fast or faster than they're being brought into the marketplace. And the only thing that increases this is an economic slowdown wherein investment capital dries up and people quit transacting. Then zone 2, and nominally, and this is again because it's a conceptual model, I can talk that way, has a boundary on one side of roughly 5% and up to the 15%, less than 15%. And that's, we call it owner finance, for lack of a better term. And owner finance these are typically locations where the real estate is pretty good, the remediation or other impairments are significant, but not overwhelming. And the owner typically has got a situation where the entire value is, I mean, they paid off, it's sunk. They don't owe the bank on this. But the owner has.
They don't own the bank? Is that?
They don't owe the bank. They own the property. They don't have any mortgage on it. There's no debt attached to it. This kind of a circumstance is very common in the marketplace with corporate owners who have purchased the property over time and now no longer need it, but their activities on it have significantly enough impacted it that it doesn't appear to be investment grade, or it might be on the marginal boundary of an urban fringe where it's, the development hasn't caught up yet, or it could be a whole number of things that depress its value relative to its impairments. So
Example of that one?
let's see, local example of that one, actually.
Denver West, something kind of like that?
No, you'd be looking at, what you're looking at is a property that, for whatever reason,
Belmar, maybe.
no, Belmar's a public-private deal.
Okay.
These are deals where, and I don't know that we've got a good local example of this, quite frankly. But you got a situation where you have a site that's on the, ahead of development, so it can't achieve an IRR in a timely fashion, right? Because that's one thing that will degrade IRR. or its environmental costs are significantly higher, where as you look at the risk-adjusted return, again, you're not going to get to a point where you can take and attract investment capital.
So is that where like somebody might make a bet on developing a development a bit too far out? So everything hasn't come out to meet it yet, they spent all this money to develop it, no one wants to live there or work there because it's a little
Usually,
too far away, or?
It'd be more likely,
Yeah.
it'd be more likely to be a situation where, and I can't think of a really good example that's evolved, but where a corporation needed a manufacturing site, they put the manufacturing site out on the edge of town because they wanted a buffer zone around it, whatever. Development has now come around it in some density, but it's a big chunk of property. They own it, they've been there so long, they've owned it. But they kind of crapped on it, because it was just an industrial site. But its future use isn't going to be industrial.
Okay.
Nobody needs another plant out there. It needs to be turned into something else. But the debris and residuals that they've left there are sufficiently enough of a concern that, it's not going to just be plowed down and put into homes. Something has to happen there. And then those impairments are large enough relative to the return to be gained by the future use that it won't, and it takes long enough to do that regulatorily and so forth, that you can't achieve the investment returns.
An example of that
It's
would be
gates,
the
okay.
the Hamilton Sunstrand site at Pecos and 68th Avenue.
Oh, up north, that goes to 60, which one is it?
Hamilton Sunstrand.
What is it right now? Is it
It's a
industrial?
residential redevelopment.
Midtown.
It'll be a 300,000
Oh, okay,
square foot.
yeah.
Midtown.
I just remember from seeing the ads and stuff.
Yeah.
So it got to a point though.
Yeah, another example of that would be sites located along planned transit-oriented development lines, where someone's planning 6 years from now to have completed a
Yeah, TOD is a really good
TOD.
example, because a lot of times they put transit down the pathway of least financial resistance.
Yeah, like
Right.
44th right now,
Right.
with
Yeah.
all that going out the
And
airport,
then-
that's gonna grow around all that.
Right.
Well, it already is by me at Colorado and I-25, they're putting in the brand new apartments.
Now
Yeah,
now
okay.
that changes the value equation.
Absolutely,
And so there's, and this is a dynamic model, once you're in
Yeah.
one zone, unless you're way out here, once you're in one zone, you can do things, and gets down to the management discussion, you can do things as an owner in here to push it one way or another.
Yeah, okay.
Inadvertently this way or intentionally that way.
Right.
And we can discuss those. But just to complete the discussion,
And Mick?
Yep.
just maybe this comes into your discussion in a minute. Is owner finance, or is it also essentially creative finance?
Yeah, it's alternative financing.
we could call it alternative, but.
My
yeah.
point being that you could have owner finance to a certain point in the deal, and then it changes, or they take first layer risk.
The intent here is not to define the capital stack,
Right.
definitively.
But that's where a bank might come in and take at least a portion of it, because they see it as an upside investment?
There are no banks anywhere on this diagram,
Oh, okay.
The only place you can find a
except
bank.
way out here.
Way out.
Yeah.
Okay. So who would the alternative be there, just investor, private
It's
investor?
alternate structuring. In other words, what you're doing is you're essentially taking the lower cost of capital from a large entity, right? Because their cost of capital is 5%. That's why they get the 5% number, right? They can essentially bridge that to a public or a private investor, but today, nobody is going to take and do it that way. They just can't. By the time they run the math, they got a 5% deal, and they're not touching it.
We're doing a project right now in Tennessee with the Alcoa company, and the only way we have a chance to get to here, or better, is with them essentially holding the property by giving us a lease on the property with an exclusive option to develop. So we didn't have to buy it originally, we didn't have to borrow from the bank or investors to put money in. So consequently, I stopped the clock. Time's not ticking in that regard, right? So from that standpoint, they are able to hold on to it because their cost of capital as a large corporation is much smaller than what the investors demand for a return in the investment market. So because of their size and so forth. So and it's all sunk cost to them.
Yeah.
They paid for it 100 years ago.
Yeah.
Right? So And then there's a whole bunch of other issues around that, but the point being is that they can afford the patience, I can't.
Yeah, that would be a joint venture type arrangement, Kelly, right? Small J, small v, not a formal joint venture, but like Rick said, company contributing land at a basis.
In some contractual form, they contribute the land.
Right.
And then the developer on this side tries to turn it into something of more value
Push it
through
out.
the entitlements process and creative remediation and et cetera.
Okay.
Going on down the line then, in the public partnership, and this gets a little fuzzier, but the intent with the public partnership, and sometimes called public and private partnership, triple P, you are using public money, and this is the part that's important for the public to understand, that public money has to be first in the stack. Because the public money is an investment that, relative to the private investor, from their point of view, is pushing it in this direction. So you can see that the further you are to the left of that sector, the more public money has to go into it before you get yourself over here in some place that private money wants to jump in and go.
Yep.
But this is often done in a circumstance where the returns that the public, and I tried to use the term when I talk to public officials, I treat them as investors. So the public investors, they have different returns and return potential than a private investor, because they can be concerned about social justice issues. They can be concerned about making sure that their blight, either blight from an economic standpoint or blight from an environmental standpoint, is reduced by having this transition. A lot of times these are anchor properties within districts that get converted. They convert the entire district when they go away. The Globeville example up here in Denver, there's a tremendous amount of money is going to go into that, to the point where now it's just beginning to ignite on the investment side.
Which one, what's that example?
Globeville,
Well, the stadium district even more so.
yeah, Stadium District, right?
They're gonna put $1 billion into the stadium district in the next 10 years.
Right there, like below 23rd.
Public money.
Yeah, well, from essentially, they're not stadium, the stock show district. So
Oh,
it's-
West
My
Stock
bad,
Show,
my
West
bad.
Stock.
Stock show and then north onto
Yeah.
the old stock show site.
Yeah. And the interesting thing
They're
is,
gonna put $1 billion worth of public infrastructure and
Yeah.
rehab into that whole area.
and because it's gonna make that location more desirable, it pushes the value of a brownfields property in that area. The reuse value of it is pushed way up
But it's
because
coming
of the
from a
investment that was
public
made over
installment
here. Right.
That's where that one's
Yeah,
used.
Right.
You got it.
And is that also, is that because of the I-70 stuff they're doing too?
It's part of it.
That's part of it, okay.
Yeah.
But it's actually, that is in addition.
And we-
I
and
guess
it's one of the-
230 million, and we got $1 billion in aggregate from CU and CSU. and
One of the
Denver,
reasons why
and
we,
The stadium tax is paying a big piece of it.
we prefer the phrase impairment rather than environmental or
Mhm.
brownfields, because you can have economic impairment, you can have neighborhood impairments, you can have other reputational impairments, you can have a whole bunch of other kind of impairments that can impact the neighborhood and the subsequent value of that property above and beyond just an environmental problem. So.
Yeah, because they could be socioeconomic, they could be political, they
Could be the freeway goes right through the middle. and
They
now
could
they're
be
gonna change the
geographical,
freeway,
right? If
Absolutely.
you gotta knock a hill
Access to
down.
transit, you
Yeah.
know, all kinds of stuff, right? It's the same dynamic. The fundamental difference in my mind, between the brownfields investment area and any other real estate investment area is just the fact that the real estate, for most investors, or the environmental side of real estate, is still a very smoky black box, and they don't understand it. But they deal with a lot of other similar impactful kind of complexities day in and day out, as it's just normal. You know, everybody's afraid of the risk they don't know.
Now, you said that on those, Mick, that the public investment is at the highest part. Is this where you guys
Has
are
to
talking
come-
about the stack?
has to come
Is there
in
also
first.
other money in it?
First.
Has to
bottom
come in
of the stack,
first.
but
The
What's-
bottom is one way to look at it, yeah.
What's the other money that would be in it? Can it be, any makeup at all?
Well, this could be an upside down transaction with a private seller, right?
Paid to take.
The value of the environmental exceeds the value of the real estate, but the real estate has some developable
Upside.
value upside, but for that. environmental.
And I think that
And that happens.
that can be, I mean, if you think about it, if you look at the graph, the further are you out here, the more money you've got, someone has to put in before the investor.
Just to move it up through the spectrum.
Right,
Yeah.
before the investor is triggered, right? So the further you are out here, the greater the investment to get to the point where you can transact to an investment grade seller. Now, you know, we have given property away here,
Mhm.
right? Just in exchange for them taking on the long-term care. So as you get further out here, this is the land of hopeless, right? They're just so financially daunting to try to move it in that direction that, and this, the perfect example there is the abandoned mine sites in the mountains, where they're so far from any other potential economic use, and yet the environmental cost to them is
So
long-term and significant. And it just buries, so from a transactional standpoint, it just buries that so deeply in the negative that it never comes out without, and even then, EPA and the other environmentally oriented organizations don't have enough money to drive it even to neutral.
So, but the way, one of the ways that can change though is say like, so a lot of the property around Telluride might have been looked like as that in the 50s. But as Telluride caught on, it moves up the spectrum because
Yeah.
all of a sudden people want to live there, and all of a sudden
Yeah.
they start remediating stuff and they get more money from EPA.
Alta Ski Resort in Utah
Utah.
was built on old mine claims,
Okay.
and they had to deal with mine drainage.
Yeah, you're right. Essentially, you're saying the market has risen more than the environmental cost, and as a result, you can actually start to calculate an IRR that works. The market came to it.
In that instance, but the farther left you go in the spectrum, the more you are weighing more risk to see at what point in time or how much money is going to get you to the right. That's really what you're looking at.
Yeah.
Okay.
And what you're describing may fit more in 3 than 4. There are sites in category 4 that no one's ever going to come to.
Yeah.
It's just not going to happen.
Yeah.
Right?
Rocky Flats, the Arsenal, those
Yeah,
are.
it's just not going to happen.
They're so expensive, both, you know, regulatorily and technically and so forth, they just, you know, adversely.
Politically, reputation-wise, it's just not going to
Right.
happen.
I mean,
Yeah.
think about Rocky Flats.
Yeah.
Rocky Flats is all political and reputation. The reality of it is, there ain't that much left that's a problem up
No,
there.
Yeah.
it's,
Go, and by
Yeah, there just
definition,
isn't.
by definition,
No.
less every year.
Yeah.
yeah, technically, right?
Yeah.
We made plutonium bomb triggers here. Would you like to put
Yeah.
a house there?
Yeah, right.
Probably not.
Just
Good
explosive.
history.
All you need is explosive growth. So the question, so the point of this, that I use this diagram, is to try
I
to
don't trust
help
anything that lies
owners of property,
magnesium.
people who deal with brownfields from in some portion of the transaction in any way, shape, or form, to understand the fact that they have to be aware of where that property sits on this continuum as to where they should be paying most attention. Because right now, for instance, the environmental regulators, in most cases, not all, tend to treat every one of these uniformly. They treat it exactly the same way. And that's a huge mistake from a societal standpoint, because they're inhibiting property that could have much higher value use by not allowing it
Because they're holding it back.
holding it back because they want to treat it like here.
What's an example of that, of one that they should treat differently?
I think the Lowry example was perfect. I mean,
That was one that they treated properly.
yeah,
I mean,
well, up to a point, but I mean,
Below Stapleton, that area over there?
yeah, I mean, I think that,
again, there
I
was
mean,
enough,
I
there was
think
enough
Lowry
money.
would be probably a pretty good example of how that worked, where they did, they allowed a privatization, creative deal structure to go through.
The federal government.
Federal government
Put 70 million
put
bucks.
a bunch of
into it.
money into it, because otherwise it would have been, you know, I mean, by itself, when it started, it was a Zone 4 deal, no question. It required federal money, it required a couple $100 million. worth of
And the
private
regulators,
investment.
and
They finally
the government
tried
and
it over
owner
the
were
edge
treating it that way.
here, right? But if the regulator had failed to allow for some creative thought, it would still be there. It would have shut down. And in fact, where it was headed was shutting down, and the state and the Air Force fighting for decades over who was going to be in first. And it would have stayed right in Zone 4. Because the cost of cleaning up and the ability to change it wasn't going to, it's primarily because of time, by the way.
And if you've been
As an
alive,
investor, you couldn't take and figure out, am I going to build houses on it this year or next year or a decade from now? And so I can't calculate an IRR, so why would I touch this?
from a social standpoint, if you stand back and take a little bit more of a macro view of that one, the value added to Denver and the value added to the federal tax base associated with the redevelopment of Lowry far exceeds the cost they did to clean it up.
Oh, yeah.
But the same agencies don't benefit.
By about
Right.
by about literally a factor of 40. They put
And that's
$70 million
yeah.
into cleanup, $100 million into cleanup.
Yeah, I would
Yeah,
have
the Air Force is-
said, I would have said Lowry was on this side of 3. I wouldn't.
$4
say-
billion worth of economic benefit created in Colorado.
Wow. Okay, so,
So obviously, I mean, Kevin, if you're looking at a piece of property and you have an idea that which of these it's in, and frankly, Mike's model, he can tell you which one you're in. When you run the model, he can tell you where you are.
because you're gonna get the breakpoints across the bottom. You're gonna say, here's where you're at with your IRR,
Right.
right?
Right.
Right.
Just look at it and tell right then.
Right, here's where you are. And I believe that the sweet spot for our advisors business is right here.
Yep.
And also, you'll notice that's the highest population.
And that's for advisors, and then obviously Dwight is all right-hand side.
Correct.
Or the farther to the right he can get.
Yeah, as
Right.
far as you can go,
Yeah.
as far as you can get. That's
Now,
where you want to be.
the further out we get here, the more competition we have from traditional real estate.
Yes.
But, and because I think that our sweet spot on advisors is right in here.
So would you say that if you say, especially back on advisors, your sweet spot's actually in the heavy part of the curve, is that because of your experience across those integrated buckets allows you to better understand and assess the risk and what it needs to get away from the risk to move it to the right? Is that why you guys like playing there?
I believe it's because our integrated approach, that without integration, you might be here, and with integration, you might be here.
It would get you to-
Because of cost savings or value increases.
Yeah. And with integration, if you're on the left side of 3, we can give you a much clearer picture of what it's going to take to move to the right, that then you could decide
Right.
about.
Mhm.
Right.
And without integration, we would say the only place where we would say our competitors could effectively play is actually, they wouldn't be able to take your property farther to the right, but they're just going to be in properties farther to the right because those transactions are cleaner and they don't require as much knowledge,
Right,
right? I mean,
right.
is that really it?
You don't need.
They're easier
You don't need the integration as you head to the right.
as you go to the right because it's cleaner. It's a
Yeah.
cleaner
Yeah,
transaction.
there's an entire world of real estate transactions built around that.
And so the upside that you guys are exposing and exploiting in the middle part of that is where your value position is really.
Well, and
It's all
it's,
value add.
and it's understanding where you are, right? Because I believe over in here, the problem with the public, whenever you add in the public, you've got to deal with the dreamers.
What's an example of that?
The ones who say, I'd love to have a dog park here, without saying, I'm willing to pay how much for it to be a dog park? Right? Whereas I could put it into apartments, as an example, and that would increase the value and put it over an investment grade, and I can attract investment capital to do that.
Because those are directly revenue generating, and the dog
Right,
park is socio.
Yeah, exactly.
You gain social benefit
Yeah.
economically, it's a zone 4 deal.
So who's gonna pay for it? That's the answer, who's gonna pay for it? So, but the point is, I think that we have a great deal to add into the public sector ownership, decision-making process in this sector. Because, as we said before, public money has to come in first. That's really a public investment area where the first investor in have to make the decision to invest, has got to be at the public level, which is a very complex and messy process that goes far beyond a good financial analysis, because you got the politics and the dreamers and all that involved. But once you overcome that, now you're moving in that direction. But the beauty of advisors is I can tell you how much money it's going to take you to move it there. You'll have a dynamic model. So if you want to say half of it needs to be a dog park, there it is. Can you afford that? Can't do that. Sorry, folks, can't be a dog park.
We just sent out a proposal on exactly that topic today.
Oh, really? Yeah.
Yeah.
It should be a lake
And that's
$44 million hole
the-
in the ground.
The GE property is
in Tucson.
a classic upside down deal, high intrinsic real estate value, but for the environmental, 25 and $30 million worth of land value. $1.6 million per acre as clean, but $40 million worth of environmental liability.
Oh, darn.
So
Yeah.
that's the right to check. So, right.
You're zone 4.
And then as an owner, you got to decide how much.
Well, and just, exactly, and a couple other thoughts. I mean, just think about that example, for example, right? Your traditional appraiser, and I think this is where the integration becomes important, right?
Real estate appraisal.
Real estate appraiser comes out and says, hey, it's worth, what, $1.6 million an acre, right?
Yep.
He's gonna take and give you a report, burnished, all shined up with his credentials and everything else, zone 1 deal,
It's
Right?
clean. It's clean.
if clean. But it won't lay it out that way, right? So now expectations are zone 1 deal, right? And without taking a look at the entirety of it, nope, not zone 1, not even close to zone 1.
Have
Right.
you've heard the phrase highest and best use? This is really about the highest and best possible use. Because the possible is affected by the cost to get it to that use.
Mhm.
It's more expensive to clean up and put in residential than it is typically, than it is to put it into commercial, than it is to put it into industrial. So if you can, but
Say
the
it
difference
again.
in land
The
values.
spectrum which way? It's more expensive to start with residential? is that what you
No, it's more expensive to clean up to residential standards. That's a higher
said?
standard.
Than to clean up to industrial.
Yeah, so if the land values are in that same pattern, if you're really in a residential neighborhood and there isn't any market, nobody wants to put an industrial activity in there, or you won't be allowed to by zoning. And there's plenty of retail space, so you don't need commercial, and nobody wants those uses, only residential, and that's your only hope to transact. It might be in your best interest as an owner, just put a fence around it.
You have to hold it. So, because you could say, all right, right now, or you get to decision points, right? You can say at this point in time, because of development or because of regulation change or politics,
Wait.
it's ready for industrial, and I could make a little bit on it.
You wait for
But I
the
could
city.
still even wait longer,
Yeah.
let more development happen, more regulation get pulled back and say, but now I can go retail. My margin's this much bigger. Is it worth waiting that amount of time, which is what you'd be able to
What's my
find?
carry cost worth to get from A to B?
Yeah.
I
Or
just get excited when I
or
start to
alternate.
understand things. so.
Or alternately, you also understand how much public money you might need to satisfy the public interest.
Yeah,
in
but you
having
can
it ultimately
intelligently
be
have those
residential.
discussions at that point.
But think about what you just said, right? And this is what I think is key to this model, is usually in our business, it's expressed in terms of, well, we have a plume with 100 parts of TCE and it covers 4 acres. And it's gonna take 6 years to clean up. We think it could be 10, could be 5. And by the way, we've got, these legal issues that deal with covenants and other things, and we're not sure about how that's gonna work necessarily. That's the vernacular of these deals. Do you understand and appreciate that? Right? Or, hey, we got a site, it's got a groundwater plume, it's gonna cost us $500,000 to clean up over the next 10 years. It's gonna generate, over the same period of time, it's 10 acres, it's 60 to the acre, it's 20,000 a door, so it's a $12 million property. So let's see, where does that tell us we're at? Oh yeah, we're way down the road in zone 1,
Mhm.
right? You guys got the second
Yeah,
argument,
it's
didn't
easy
you?
to go.
Same discussion, by the way.
Yeah.
And that, I think, is one of the huge differentiators of what we're doing here, because our industry doesn't recognize capital stacks, doesn't recognize the financial drivers behind these deals. But when you get the right audience,
The-
it's like, oh, I'm a public-private partnership, and my developer, we had a deal the other day, came in, and this guy said, well, these guys are building this apartment building, they want $2.5 million to go and do it, we're not sure we feel comfortable about that. So we ran some quick math on it, right? Appears to me that $2.5 million essentially covers their equity commitment to get to the leverage to do the deal, right? They want public money to come into their deal, and they're getting all the upside for zero. Their return on that deal is gonna be infinite.
100% at that point. right?
No, it's gonna be infinite, because it's gonna be whatever the
It's
number
everything
is
after,
over
it's everything
zero.
after that.
Right.
Yeah.
Right?
Somebody else's money.
But my point is,
to do it.
you know, so if you're a public official, is writing a $2.5 million check to the guy who already should be able to do the deal the right thing to do?
No.
No.
So
Now,
how much then, to your point around what you guys are doing, the two examples that you gave, the first one was completely lacking of accuracy in data.
Well, it actually, interestingly enough, it is replete in both.
No.
It's just not, you're talking about the one of the plume. and the-
Yeah.
Yeah, it's backed up by mountains of data, and it's totally accurate. It's just incomprehensible to the layperson.
Well, it's also.
They haven't taken the time to break down what it's actually gonna take to
No.
get it there. though.
Yeah.
Nobody knows what it means, right?
Well, it's a-
Yeah, data is just data, it's not.
Once you hear that, they don't,
Yeah, it's
it
like,
doesn't register.
Regulatory
Yeah.
compliance.
that sounds bad, you know, I don't know what it
Yeah.
means, but it's bad.
Transaction.
You
Yeah,
know,
it's like,
and
oh,
the one
eventually
go-
in 10
But that's
years.
what I mean, you guys are taking the time though to apply more insight, ironically, insight, right, and data into that, look, we can tell you what that means and how long it's gonna take, whereas it's almost feels like the first example is like opinion and gut.
It is.
Right.
And so they just sound like, well, that sounds really bad, I'm not gonna do it. Or, it sounds risky, but maybe I'll go for it.
Yeah.
Well,
You know,
and,
it should be the other side.
and even better, now I've talked to you in a whole bunch of vernaculars that you're not necessarily versed in, right? You decide.
Yeah.
So how are you gonna
Yeah,
respond?
it's still gonna be your decision.
Well,
Are
fast-
you, are you making an informed decision?
Yeah. I mean, in corporate America, this is what Mike has to deal with all the time. In corporate America, these questions on these kind of assets are always on the side of their business. This is the stuff they don't need. They're focused on the stuff they do need, and the whole corporate tower is built around people whose experience is in building widgets, because they're industrial widget Inc. They're not real estate Inc.
Yep.
So the whole management structure, which is all organized to flow up in authority and responsibility to the top, is all built around knowledge of widgets. So now this decision comes along, but they follow the same decision path that they follow when making widgets. And so what happens is that the decision authority is built up to the person with the least amount of experience and insight. And they're being asked to make the decision. I'll give you an example. We were looking to buy a piece of property in Maryland. And I gave my top offer. They said they had a better one. They took that one. I've been kind of tracking it, waiting for it to kind of fall apart. Well, it fell apart.
It wasn't a zone one deal.
It fell apart, and I thought, oh, I know exactly why it fell apart. So I called to say, kind of like a nah. And she said, well, the gal was my contact said, she said, well, you can't tell anybody I told you this, hence I'm not using names. But she said the problem is that went up to the CEO, and the CEO killed it because he was at a cocktail party, and he was talking to a guy who's in the real estate, runs a big real estate brokerage outfit at this cocktail party, and he told this real estate guy what he knew about the site and what the price was, and the guy said, "You're crazy. That price, that much land and that much location, that's got to be 10 times that much." So he came back and he said, "No, we're not going to do the deal. I'm not going to be embarrassed by having taken less than it's worth." And the guys who were, the money that they offered for it was more than they should have offered. The guys who were going to buy it were going to get hosed at the price that they asked for. But the CEO had no idea, other than the fact that he had the authority and the responsibility. Therefore, he felt the need to say no, because.
But he took the highly inaccurate opinion of someone that is only in one of those buckets, looking at it only in one way.
Right. Yeah, and with.
We've got reaction on uninformed opinion.
Yeah.
Alright.
But, so the advantage that Mike offers when we go into an organization like that is, he delivers a financial spreadsheet that's significantly more complete than most corporate people are able to do, because their information is compartmentalized at their level. He integrates that information. And it flows upstairs in an integrated fashion to the people who can read spreadsheets and can understand how things all link together. And that's a convincing argument at that point.
It's Moneyball. That's what we talked about last time. Have you seen it since then?
No, no.
You still gotta watch, you gotta watch it
But
this weekend.
I read about sabermetrics all the time.
All right. I had a question for you. You said that an appraiser might go out someplace and take something that was a zone 4 and appraise it like it's a zone 1.
Oh, yeah.
How does that happen?
Because they have
They
no,
qualify their appraisal.
What do you?
they disavow, essentially they take the singular, I'm qualified as an appraiser to appraise clean land, right?
Clean land is the.
Or
So
clean
they assume
building.
it's clean?
And they.
Right, and so we assume it's clean.
They,
So we
So
assume.
literally as he's walking through tailings
Yeah.
on a site, he's like, I'm just gonna appraise this the way I appraise everything.
and they just put a note saying does not include any consideration for
They
environmental.
just claim themselves.
Right.
But then the person gets their appraisal saying, this is a zone 1 deal. And then they wonder why it never goes to zone 1.
No, typically what they do then, typically what they do at that point is they call up their environmental consultant, who's been sending them reports recommending additional surveys and additional examinations. We found some more, we need to take another look. And ask them, well, how much is it gonna take to clean it up? And with a question like that, the consultant is not given the context. He isn't asked, if we were gonna turn it into residential, how much would it cost? Or if we're gonna turn it into residential over here and not over here, and how that's all laid out, and how much would that cost? He just says, how much is it gonna cost to clean it up?
Not only that, they pull their attorney in as well, right?
Yeah.
And those are what we combine is the real estate finance, environmental, legal, and risk management.
And everyone else is just looking at one
And
of
this
the
is
ones.
Piece of the puzzle.
This goes back to how we, the basis in which we founded the company to begin with, 15 years ago, almost 16, which was watching deals fail for just that reason.
Because it was only one lens.
Because the decision makers couldn't integrate all the different advisors they were getting into a one package to come up with a one vision of what the value ought to be.
Yeah.
Because a lot of times they're competing. They're competing for their part of the solution when they're going to the principal.
We talked about the appraiser example when we talked about the environmental consultant giving just one price as opposed to options. And then what was the one you did? Was it with the lawyer?
Yeah, same thing, they'll call it an attorney, they'll call it an environmental consultant.
We don't need to clean this up, we'll sue the bastard.
They'll call a risk manager, right, an insurance broker to figure out how to get protection against risk.
That's okay, I can write you a policy.
It's an example on how one property, depending on what the assumptions are that you make, you can go anywhere from deep into zone 4 to barely into zone 1.
Right.
Again, the point being the value of integration. Because you'd see from the appraiser is one line item up here,
That's clean.
net as clean value. That's how far they went in their analysis.
Line one.
Line one.
And somewhere in their archives, they have another line, which is remediation costs. The two of them are not linked at all.
Yeah. Feel better about what you did?
I didn't think you'd feel bad.
I didn't think this either. I gotta tell you, nobody looks at stuff this way. They really don't.
Right.
I don't know why not. Why not?
They just,
Do they not know that you're a resource? Do they not know that you can dive this deep into transactions? Like, why don't? Because it just seems logical to me. Which is,
Well, I mean, we've been dancing with GE for 4 months now, 5 months now, to show them value. And ironically, yesterday the light came on.
I think the answer
They
to
said,
your
we need to
question.
hire you guys, and we need to involve you in other projects.
Good.
So, but it takes time, right? It's a process of
It's an
of
education.
and
Educated market.
But
yeah,
certainly back to what you said
credibility
earlier.
and validation.
Certainly back to what you said earlier, though, I think that it is, that the answer to that question is more a function of the class of potential customer. Because I think that the problem with why they don't see it is different depending on the market sector we're looking at. Like, for instance, in the case of the public owners, they're just generally clueless, but they haven't a lot of expertise in doing investments. They don't think investment oriented, they think budget oriented. And so they're
Yep.
inherently not even trained for the most part in thinking this way, which inhibits their ability to see it from a broader sense. But you know, they need a lot of education, a lot of training and so forth. I think in the case of corporate owners, the problem that they face is the segmentation of responsibilities inhibits their ability to bring together information, because in some cases, even in some corporations, they won't share information with each other because it's not your department.
It's powerful at that point.
Right.
It's a cultural issue.
Well,
It
and-
can be a cultural issue, particularly in the largest corporations.
And let me ask both of you this question, because it seems to me that they also suffer from the same budget problem. These assets lie in a don't spend the money part of the company, right? And so, again, they don't look at this as an investment, which is,
No, they maintain a lowest cost.
It's a cost.
this is an
Yeah.
investment
Cost.
analysis, not a cost analysis. And so, you know, they
And I
look at
think
it
they
from
really-
that perspective, don't you agree?
At the point where we get into having these kind of detail, the level of conversation in the presentation, Mike has some very powerful graphics that show the value of that they might return by investing in pushing it to zone 1 versus holding on to it for a period of time. And he's got some graphs which, you know, come out at different time
Mhm.
zones, at different heights of return. And I think it very clearly points out that there will be radically different outcomes to different alternatives, with different way of graphing and kind of essentially what's there.
Right.
But I think, and that's what I said earlier with, you know, graphics important in this one, because these are complex circumstances, and if you can reduce them to a graph that is intuitively obvious to the viewer, your conversation is going to be a lot easier, which was one of the reasons to come up with that conceptual model to begin with. But I think also in the case of, to answer the question, why we can play at that boundary on the investment grade, is that for the vast majority of investors in real estate, they haven't had to invest in this sector. There's been enough opportunity for them, or they have perceived there to be enough opportunity in the traditional sector that they haven't had to play here.
And
so they-
actually, as long as there's positive growth, it would stay that way. You guys would maintain your niche longer, right? Because
It has to do, in my.
it's harder to play where you guys play.
Oh, yeah.
Yes,
Oh,
yes,
yeah.
yes, right,
Yeah.
Yeah.
right.
So it's actually, yeah, okay.
Fear and,
I mean, there's
fear and
exterior
greater
forces too.
transactional cost.
I mean, market cycles will drive land towards the right?
Yeah.
I mean, we're almost in that cycle right now.
Yeah.
Real estate
Absolutely.
fraud is starting to develop again, much like it was in 2005, 6,
Yeah.
and 7.
In 2007, it slammed the other way.
Yep, yep. Yeah, so, and when that happened, everything moved to the left.
Which
So
is
just instantly things that may not have required much were also considered zone 4.
well, the reality is that when
The market went there, right?
yeah, when the curve went that way,
Yeah.
right? Our reaction was, oh, this is the buying opportunity of a lifetime,
Absolutely, yeah.
right? But we couldn't convince the money.
Ah, yeah.
The money was scared. So the education, we didn't have the education in place at the right time.
So, I've got my own opinions about this. So we've gone through what this is. So let me paraphrase some things back to you guys, just in terms of starting to bucket this out. So this is a conceptual model, right? And so we might end up packaging it up as just, I mean, like you can see, like from a content standpoint, this might be the Recite Insight or something like that, right? It's your intellectual property, right?
Like that.
But it's really a conceptual model. I want to come up with a different term than brownfield, because I hear what you guys are saying around it, where brownfield falls. We'll come up with something different, but of the brownfield
Compared
market.
assets, compared real estate assets.
And what it does is it basically helps people understand the IRR breakpoints across all types of properties that they might either already own or look to be invested in, to really see more in depth what it's going to take to get them to the return that they want on something, based on what's involved with it.
Right.
That's what this does. And how it does it is it breaks it into these zones, and then how you'd actually help them do the insight is actually be using realm,
Right.
right?
Yep.
Is actually how you do it. So why is all this needed?
But you can't articulate how you're gonna transact, you don't transact.
Say more about that.
Well, if you can't, let's say you're a economic development guy, right? Over in zone 3, right? How much money should we invest? Why should we put $6 million into a project? And if we do, are we gonna attract investors or not? Why or why not? I gotta go and ask for $6 million from the city council, and I wanna know why.
If I'm the mayor, I need to know whether
I wanna
whether
know
getting
that,
Right.
you know, that's gonna get me a project that's gonna work, and it's not gonna be a sweetheart deal for the developer. I gotta know that you struck that right balance. If I'm the surplus property manager for a major corporation, right, and I wanna go sell property, well, my broker comes along and says it's worth $15 million. That's great. Oh, but brokers like the wonderful appraiser we talked about, thinks about what it's gonna be, not necessarily about the cost of what it's gonna take to get there. So, you know, I'm shocked by the fact that my $15 asset doesn't transact, right?
Yeah.
This helps me define, what do I need to do? Do I need to take and hold this while, you know, maybe I option it and have the guy get his entitlements in place so he doesn't bear 15% money for 3 years, which by the way is half the purchase price, you know, while he's getting entitlements that will allow him to even decide to proceed when I can hold it for, you know, my carrying costs. And I need to be able to articulate that to my management to move this property.
That makes sense. So it's the example you gave earlier where someone, you know, saying generalities versus,
Right.
here's the actual, this is
Mhm.
what it's gonna take now. It might be 10 years, it might be 15, we don't know.
Yeah.
Right.
Making that information clear.
Right, exactly. And so it's providing, I mean, this thought process helps people start to think about what their alternatives are.
Yep.
And I would say that the technique significantly increases the accuracy of the decisions.
The what
The
does?
accuracy of the decisions.
What increases the accuracy?
Our process.
Yes.
Right. There were maybe other attempts that looked to be more precise, but they're not more accurate.
So a lot of this is the example that you gave. If I'm a guy with a zone 3 piece, I need to be able to, exactly use your word, articulate to the people that I'm gonna go stand in front of and ask for
Mhm.
money, how we're gonna get it to a 1.
Right.
And more importantly, with this depth of insight into that, the options of how that could transact, there might be multiple stories. So we can
Could
say,
be, you bet.
which ending do you want? If we can get it to zone 1, but in a number of different ways at a number of different
Right.
times.
Mhm.
But I can tell you all those stories. It's almost like you're helping them really articulate
Exactly.
the financial story based on data.
And articulating it in a far more convincing way. In other words, by going through this process, you're not saying, well, here's a bunch of fuzzy data and fuzzy facts and fuzzy lawyer opinions. You can go option A, B, or C, but I can't particularly tell you why it's good to do one or the other, right? In this instance, you can say, you get this, you get that, you get the other thing. Here's the cost impacts of 1, 2, and 3.
Yeah.
Right? And so, you know, if the best one's this one, but you really are in love with this one, okay, great. That means it's gonna cost us X amount more because, that's the difference.
It's still a decision you can
Right.
make, but now you know what it's gonna cost.
Right. We really need the money. We know the neighbors are gonna be pissed, but it's worth fighting for the money.
Yeah.
Okay, fine. So, okay, so it helps you define then your strategy going ahead, which is huge because one of the other issues you run into in projects like this is you get into it and you don't know what your outcome might be. So you go and fumble around in the dark without having at a high level evaluated your alternatives. And you find out that, oh shucks, we ran down a bunny hole and it didn't go anywhere, and so now we have to go back and start over.
Like that.
And by the way, the bunny hole experience, that's sunk cost.
Yeah, absolutely.
Gotta go find a new bunny hole.
Let's start over at that point.
Yep.
There's a couple other markets that we haven't talked about, potential users, one of which is in the mergers and acquisition environment.
That's kind of where I was starting to go, because I could see, tell me if this is where you're going. I'm the Zone 3 guy that wants to articulate why you need to come with me as an investor. Other market is, I'm an investor with a Zone 3 guy coming to pitch me. I could potentially engage you guys to pull the deal apart to know whether or not he's full of it.
What I was thinking was more a matter that in the corporate world, a lot of times buying and selling divisions or product lines or whatever, it's like, here, take this too. Right? So you buy the adhesives division because you're in the adhesives business and I'm thinking of getting out of it, so I'll sell you my division. But I've got 4 sites I don't use anymore.
Yeah, there's 4 old
Right?
plants somewhere.
And I don't worry about that. Don't worry about procurement.
It's fine.
Yeah, few taxes, it's not a problem.
Gotcha.
But what's it really worth, and why should you be buying it? I mean, some of the worst deals in corporate history have been failure to recognize the cost, both either carrying costs or transactional costs associated with surplus property associated with that owner.
Yep. Surplus problems. Keep your eye on Kenmore's. You're gonna find out that's gonna be one of them.
Yeah.
No, they're telling you it's a zone 1 deal right now, and if you read the notes in the financial statements, and Mike will tell you, you got $1 billion thumb on the scales,
On the downside, right?
on the downside.
Wow,
But we could be wrong.
We
We could be a zone 4 deal, we just don't know it. We could be a zone 4 company, we're just not telling anybody.
$85 million, but it could be as high as 1.3 billion.
The point
It's
being,
pretty wide range
That's
of
what it takes you.
accuracy.
Yeah.
Jeez.
we're looking to be
Read the
engaged.
fine print.
We're looking to be engaged in a big purchase, a huge purchase, a very complex steel making site that has a lot of potential outcomes and costs and future projections, et cetera, involved in it. And a tool like this, that's what one of the bidders on it saw, that with a tool like this, they could have a high degree of confidence that they were going to be offering the right amount of money.
Yep.
They'd be able to sleep at night.
Yep.
So that's one example. I think the other, and the reason I bring that one out is that target market now is very high level corporate CFO kind of folks or above, and investment bankers who don't want to do the wrong deal. And so that they'll be needing to write. We'll be needing to write that and pitch that and focus that. Totally different than, say, economic development directors for cities. They can't even talk to each other and understand. So the other market that I was thinking of was in dispute resolutions, where things have already gone to shit, and lawyers are involved. Because I believe that if an attorney was to put a mic on the stand and flash his model up on the screen and go through line by line why this is the way this is the real value of this property, and that's what it ought to be, that would be so overwhelming compared to the current process in that environment, which is to bring in the appraiser who gives a clean value, then you bring in the environmental guy and he says it could be this much, and then you bring in the, you bring
Then they're
in-
all trying to do their own math
and
in the court.
And the
Yeah.
jury's eyes are rolling around, and then here comes some guy in and he flashes it up on the screen, that's the number right there.
Mhm.
That's what it's worth. That's what somebody paid for.
So with dispute resolution, M&A, what were you considering the first market that we were talking about to be?
The principal transaction market,
Okay.
principals in transactions.
Yeah. Corporations, sellers.
Sellers or buyers, owners.
And then also at the same time, when you were talking about like an M&A, you were talking about if I was buying an adhesive division that came with these 4 old sites, and I was just trying to say these are included. At the same time, you could also work with the guy that's divesting the adhesive division and say, the reason why it is worth this price is because if you take it and you do these things to those 4 sites, you actually can get this upside out of
We
it.
did a deal.
You could present that
Yeah.
proactively.
Yeah.
We did a deal for one chemical company who was selling a location in Louisiana, manufacturing plant to another one. And the deal was stalled on the potential environmental liabilities. And we, at that point in time, the way that we sold our opinion on it was we went in and evaluated the opinion. And then we said, here's a price that either one of you can put it to us in the deal. So you buy or sell, we don't care, but we'll take care of your environmental issues for that much money.
Mm.
And the deal closed. Boom. They didn't offer us any. I mean, we had a breakup fee to pay us for our effort, but the point being is that it established the closest equivalency to a market value of that portion of the price.
Mhm.
So we have those 3 key markets. Are there other key markets or segments that you look at?
What are
We
the-
don't need a lot of them initially just to start
Yeah.
with, but like,
I think you got, so what are the 3 you got?
we've got principal transaction market, M&A, dispute resolution.
Okay.
Who doesn't fit in that?
Well, the only other identified one that I would probably put out there though is the public sector, economic development, people,
Well-
things like that, because they won't recognize, I mean, one, they're not necessarily principals, but to the extent they are, they're not gonna see themselves,
Public investors. You
Is
call
that-
it public investors.
they probably don't see themselves as that either.
So where's that guy work?
He works for the city.
He works for the city, okay.
Or the
that's what-
state,
Yeah.
Yeah,
city or the state Department of Economic Development.
yeah.
Most of them are cheerleaders,
Yeah.
ready to expound on the benefits of XYZ municipality at the location for your next plan, your next whatever.
Yeah.
Well, also, siting consultants, they would fall in that. They're Bdmv or umbrella.
Yeah.
Because they're
I don't know, they're kind of on the fringe of.
they're kind of brokers but not brokers, and they're kind of, they're just kind of specialists, I guess.
Did you say siting consultants?
There's consultants who, they're firms that have businesses where corporations come to them and say that they'd like to locate a plant in the United States.
Okay.
And they want to do this and that kind of manufacturing or whatever, and, what's available.
And what permits I'm gonna need, what regulations, what I have to abide by in this region versus this region, all that
versus
stuff.
that location, right, exactly right. Right, and your experience at CH, and CH has a lot of that.
So I got the basis right now, I think, for the initial message map, and we started going to the segments.
I just thought of something.
Yep, go ahead.
And I want to ask my partners here, do we even want to pitch other consultants? I'm reluctant to get behind them. You know,
In terms of what?
subbing to other consultants.
Well, we are, right?
I know we are, but is that a desirable thing or a necessary thing right now? What do we want to do going forward? Because I don't want to.
I'll take it any way it comes, and that's how we got into GE, right?
Well, but I don't think you would. I think if, Tobietsky came on down and said, Mike, come on, I'd love to take and haul you over to see so-and-so for 30 grand, you drive 50 twice.
Yeah. Now you're asking me to say globally yes to everything, which I'm not prepared to do.
My point is, I think he would say yes to the right party.
Yeah.
Not all parties.
Right.
Well, and let me see if I'm hearing the question. You're saying no right now. If you give
My
Mike
arch
$2
enemy
million.
is over up.
Well, I'll give an example, okay, the GE
Satan
one.
offered you a document.
Right.
I wasn't concerned about teaming with the outfit that because I believe that they don't have the wherewithal or the desire to be in this side of the market, right? But I'd be reluctant to team with CH as an example, because I would be pretty certain that they would decide they could do it themselves and steal it.
Yep.
So, and because of their delivery network, they'd very quickly become a formidable competitor.
The first thing that came to my mind when you said that was, it's called, is it individual rep? Or a private rep model? Where I could see you going to individuals or very small firms, maybe in one of the 6 buckets, that are trying to play in this space, but you know aren't smart enough, but they might have a good network, they might have a good lock on a certain industry you really want into, and then making them recite certified
Oh, I see.
modeling, investment
Oh, right.
or something like that. Not to a CH on purpose, you'd have to vet them out,
Yeah.
you know what I mean? But all of a sudden they show up, they say, we're recite certified, we can drop in here and give you all this stuff, and maybe that's the first place I went when you looked at other.
Somebody tried to do that.
It's a channel play.
Yeah, somebody channel, yeah. You remember the SVE problem?
Well, the SVE one?
Yeah.
Yeah.
There's a remediation technique called soil
Guys
vapor
out of-
extraction, SVE.
Mexico.
And somebody patented it. And then they tried to, they hired a legal firm to police the patent. And the problem they had was that and I remember this because I was peripherally in the middle of it, that working for Shell Oil at the time, and we were designing and installing SVE units for their gas stations all over the country, and I got the letter, I got the nasty gram, the attorney working.
I got one too.
Yield to a royalty agreement or suffer the consequences.
Yeah,
So
exactly.
I brought it over to Shell and said, hey guys, what do you want to do? And they said, hold on a second, we'll be right back. Got out of the room, go back in, they said, well, I'll call the legal department. And they said, let them sue us. Got more lawyers. And that's my concern. If you're a small person trying to.
I do that all day long. Yeah, I understand.
You're small.
You can put it out there, but then
Yeah.
can you really
And
police
in
it?
reality-
Good luck to a small bunch of kids.
Reality, I don't believe this is a patentable intellectual product because it's built around a spreadsheet.
Yep.
And I think because it is a spreadsheet, there are spreadsheet adept people out there
Yeah.
who could reverse engineer that quickly, create something that appears to be the same.
Yeah.
But the point, and this is where I think in our delivery, in our presentation, we have to be real clear, is that it's the wisdom that's embedded in, and it's experience that it's embedded in that and displayed in that. It is not the spreadsheet that's the value.
Yeah. Understand. Fair enough.
Well, I think the only thing you could potentially patent, so this is just a manifestation of a process, right?
Could you process patent it?
Could you,
Yeah, but what's the point of that? Because now you got a patent, but that's great, but in any patent, you'll lose your protection if the process, unless the process is critically to be followed step by step, like yours. All I have to do is vary that process and say, yeah, it's similar, but it's not the same.
Yeah, I added step B47.
Right.
Yeah, I get it.
It's
I
now,
don't know. I don't
I'm
get
gonna
it.
patent a new improved process.
It's really, you're raising what you're thinking about through that channel essentially is, you know, raising an identity issue, right?
Mhm.
I mean, we're saying we have a process, or, you know, it's like the good housekeeping seal of approval,
Yeah.
right?
I do think, though, what you're saying it's going to be a natural evolution of the marketplace as more people are exposed to this. And I believe that I truly do believe that this is going to become a normal product in commerce in terms of the process relatively quickly. And I think that at that point, we will probably be looking to harvest those smaller players that are trying to compete with the bigger players who now have internalized something like this in a way that they, you know, it's buy or build, right? So
Yep.
they'll choose to build
Yeah.
because they'll see a repetitive need over time. They're going to adopt it. They're going to build their own. They're going to imitate this internally. They'll make whatever mistakes they make in terms of the inputs, but from their perspective, they've already built that apparatus.
But there could be a break point at which you decide to protect the IP and look at a different distribution model than direct. I mean,
Well,
could you make it into
I think
application or, you
at
know?
that point, we would be ending up serving what I would call the occasional or casual user,
Okay.
not the everyday
Not the
repetitive
power
user.
user.
They'll build their own.
Okay.
But for right now, the people who are potentially the power users have the most potential for us because they have the biggest needs right now.
Yep, okay.
Makes sense.
All right, so we've got 4.5 key markets, maybe 7 consultants, maybe not, right? We've got this thing, we've got it fairly packaged up, we've got the 4 markets that we want to test it to. Before we get into the channels that we want to start to exploit, who are we going after in each of these? So when we look at principal transaction market, right? What's the role, the profile of the person that we're going after? And I want to do a profile for at least the 4 big markets that we identified. So with M&A, like you
Just
said,
a trail
CFO
of thought
go ahead.
before we jump to that. You know, one of the things that we're doing for GE is that we are preparing an offensive approach to respond to an offer from a company that provided an offer to acquire the property.